Hi, I'm Steve Wormald.
I'm David Linco
from Davenant Finance Group. We're here today to briefly talk about tax issues for clients who are facing retirement. And David, tax generally in retirement, what can you tell us in overview?
Often people think I'm in retirement, I can take my foot off the accelerator pedal, I've got no tax problems, and they are partly correct. However, to take your foot off the accelerator and forget about tax is a big mistake, and one of the most common mistakes our clients make.
How so? Can you talk about accumulated losses?
Yeah, well, Steve, accumulated losses are the key asset that you need to build in retirement, because you're right, there is no tax problem. However, when and if you need to sell, there will be a tax problem. That's why you need to boost your accumulated losses. So that is a clear strategy for taxation in retirement for property investors. Boost that accumulated loss so that if you do need to sell, you manage the CGT. Now, just on that though, accumulated losses should be treated like an asset. If you pass away and have still got accumulated losses, they're a free gift. They go to the ATO. So part of your financial plan should be to ideally make sure there's no accumulated losses before you pass away.
But we do look at accumulated losses and capital gains tax when we're working with clients about properties or what to do with them.
In today's market, and I'm talking 2010, harvesting equity using lines of credit is certainly becoming a bit more challenging and tight. So a sales strategy will complement that in order to boost the amount of liquidity and the cash flow available in retirement. So that's clearly part of the plan, and it needs to be factored in, and therefore we do need to make sure accumulated losses are beefed up in the retirement plan.
We've been focusing, I guess, on property so far. What are the tax implications generally? Superannuation, for example?
Yeah, that's another common mistake that can be made. People often forget about superannuation, they focus on their property investment. However, if you've got non-financial dependents and non-tax dependents, and there is a payment from your superannuation fund, depending on where your super fund is being directed to, either into the estate possibly, or whether it's directly paid to the beneficiaries, it could trigger a tax liability in the hands of the beneficiary. So all it takes is a simple adjustment and an acknowledgement of the structure to make sure you know the tax position and indeed you're comfortable with it, and you're saving tens of thousands of dollars.
These are a few of the considerations when we consider tax and retirement. For more involved detail, your personal circumstances, please feel free to ring David or myself here at Davenant Finance Group. Thank you very much.
Thank you.